Welcome back to part 2 of our Learning the Basics series for the SIE exam. The exam is 75 questions and there are 4 categories. Knowledge of capital markets, understanding products and their risks, understanding trading in customer accounts and prohibited activities, and lastly, overview of the regulatory framework. Preferred stock and common stock are both equity stocks, but they differ in how they work. Common stock has voting rights and sometimes it pays a dividend. But a corporation does not have to pay a dividend to common stockholders, and some never do. Preferred stock does not have voting rights and it pays a fixed dividend. This makes it a popular choice for investors looking for income. There are several types of preferred stock. Participating preferred means there is a fixed dividend, but that dividend can also go higher if the company performs well, or if the company declares a dividend for common stockholders. Cumulative preferred means that if the company was not profitable and did not pay the dividend that year, it would accumulate and roll in the following years. Convertible means it can be converted into common stock if the shareholder chooses to. Callable is an advantage for the corporation, as they can call the stock and buy it back at the callable price. It is important to know that anything callable is an advantage for the corporation, not the stockholder. It is important to know that all unpaid dividends on cumulative preferred stock must be paid before common stockholders will receive a dividend. This is highly testable and may require you to make a quick calculation of what the dividend would be, so be sure to know that. How dividends work is a highly tested part of the exam, so be sure you know this. First is the declaration date, that is a date where the board of directors of a corporation announce a dividend. The second is the ex-dividend date, and this is highly testable. This is the first day that the stock trades without the dividend, so if you bought it on this day, you would not get the dividend. The price of the stock normally drops on that day by the amount of the dividend, and it is generally 1 business day before the record date. The next one is the record date, and that is the date that corporation records who is the owner, and that person gets the dividend. And lastly, there is the payment date, which is a date determined by the board of directors of the corporation on when they wanted to pay the dividend, when they declared it. Many people use the acronym DERP to remember the order for the exam. While we are on dividends, it is important to know that the practice of selling dividends is prohibited. This is when you use the upcoming dividend date to create urgency to buy the stock. It is deceptive and prohibited. Mergers and spin-offs are common in the business world. A merger is when 2 companies or more merge to make one larger company. A spin-off is where a larger corporation decides to spin off a part of their business to a new corporation. There are some basic accounting things on the SIE exam, so if you're unfamiliar with these, it is important to know the basics. The balance sheet shows all of the company's assets, liabilities, and equity. Assets are on the left side and liabilities and equity on the right. Assets minus liabilities equals the equity. It is important to know that a balance sheet is a snapshot in time. An income statement shows a company's performance over a period of time. For example, it may show last year's performance. It shows the revenue and expenses and income. Revenue less expenses equals income. Be sure to know that an income statement is over a period of time, like a quarter or a year, and a balance sheet is a snapshot in time. For example, what is the state of the company today, or on December 31st of last year? It is important to know what GDP is and how it differs from GNP. GDP is gross domestic product, and it is a measure the total value of goods and services produced in a country. GNP is slightly different, as it is everything produced by the citizens of that country, regardless of location. One thing that is very testable on the exam is recessions and depressions. A recession is a decline in GDP in 2 consecutive quarters, and a depression is a decline in GDP in 6 consecutive quarters. Debt securities are another type of product that is highly testable on the exam. Debt can be government debt like U.S. government debt and municipal bonds, and it can also be corporate bonds and some short-term debt instruments. U.S. government debt, such as T-bills, T-notes, and T-bonds, are backed by the full faith and credit of the U.S. government. T-bills are short-term, and they are sold at a discount. There are no interest payments. There are no semi-annual interest payments on T-bills like there are with notes and bonds. T-notes and T-bonds have semi-annual interest. Be very careful if there is a question asking you to calculate the interest payment, as it will be semi-annual or twice a year, but the bond will have an annual rate. So the semi-annual payment is only half of the annual payment. Remember for your exam that T-bills are short-term debt instruments, and T-bonds are the longest period of time, and T-bonds have the most risk for inflation and interest rates. Municipal bonds are another type of debt instrument, and they are highly testable. They are exempt from federal taxes. Not state taxes, but federal taxes. So they are a popular choice with people who want to reduce their tax burden, like wealthy investors. They are also less liquid than some other investments, so they are not for investors who need quick liquidity. Municipal bonds are broken down into two types: revenue bonds and general obligation bonds, or GO bonds. Revenue bonds build things that generate revenue, like airports and toll roads. General obligation bonds build things that do not generate revenue, like schools and water treatment plants. General obligation bonds are backed by the full faith and credit of the municipality, so they can raise taxes to pay the interest on the bond if necessary. American Depository Receipts, or ADR, are foreign stocks that trade on U.S. exchanges. They are subject to more types of risk, as they are subject to currency and political risk. It is, however, a convenient way for American investors to invest in foreign companies and be protected by the rules of the U.S. exchanges. Thank you for joining us for Part 2 of the SIE Basics. We hope you will join us for our upcoming Part 3, and be sure to check out all the other great content on our channel, and we wish you the very best of luck with passing your exam.